Hi, I'm Kepner CPA here in Dallas. We're talking about a client of mine, Roger, who's really upset that he's had to pay almost $300,000 in tax to Uncle Sam. And Uncle Sam gets their tax several ways. One, they get it just on the tax rate. The highest tax rate is 39.6%, and that applies to the highest amounts of income that people earn. So that's certainly one of the ways they get it. The other way they get it is they start taking away deductions from people who earn high income. Now, we've heard about being able to deduct mortgage interest and taxes on your home. When you're a high income earner, that starts being taken away from you according to a formula. So the fact of the matter is, that's another way for them to get some money. If you invest in passive type income properties or investments, that's where you're not actively involved in the business, then there's an investment tax that gets added on. And so there are all kinds of taxes, and the taxpayer who's paying 39.6% is probably paying more than that, because probably some of these additional taxes apply. So there are four other places where my client got hit. One is he got taxed for underpaying his taxes. It was a penalty. And when you get a penalty from the IRS, it's not a deductible expense. So he's just paying the price of underpaying his taxes. Now, in October, he estimated his taxes, and he estimated too low. So when we filed his tax return, he actually got a penalty based on filing his tax return late after the October filing deadline. So here we are in February. He actually got penalized $9,700 for late filing. That's based on the amount of tax that he owed as a result of finally calculating his tax and comparing it to what he had paid in. So he got a penalty on that. He also got a penalty for late payment. Let me go back to that. He also got a penalty for late payment. So when you make a lot of money, you very often have to make estimated tax payments. And he didn't, so he got some penalties for that. That wasn't very severe, but it still was a couple of $1,000s. Then he got charged interest because he was using his own money instead of giving it to Uncle Sam. So here's a taxpayer that had about $15,000 in penalties added to his final payment to make his taxes complete and up to date. So if you're a high income taxpayer, you can get hit in a lot of ways, and paying those penalties is part of that. So if you're doing a good job of managing your business, then you need to be on top of the taxes. You don't like to pay taxes. I don't like to pay taxes. I don't like to deliver the news that you owe taxes. So we've got to be on top of that. You are responsible for your taxes, and you have to be on top of it so that you know what your taxes are. So even if you're late filing, if you've paid most of your taxes, then that late filing penalty will go away. And that's 5% a month. So in his case, we're talking about 4 months at about $2,500 a month, or that $10,000. So you need to be on top of your tax bill so you don't have to pay that at least. And if I can help you with that, I'll be glad to do it. Give us a call. Thanks.